Hi, Reza here. So another question that I get asked a lot in property is, what expenses can I claim against my rental profits or my rental portfolio? Well, the basic rule in tax is that any expense which is wholly and exclusively incurred for the purpose of your rental business, shall we call it, is deductible against your rental profits. Now, the most common ones are generally claimed. So things like mortgage interest, albeit that's being restricted now for any loans taken out on a personal basis, and therefore, that are one to consider. And other common ones that are normally claimed include agent fees, repairs and renewals, that sort of thing. However, there are many expenses that go unclaimed, meaning that landlords lose out on valuable tax relief as a result of not claiming the expenses that they are entitled to. So as I said, the basic rule is wholly and exclusively. So what are the kinds of expenses that you can offset against your rental profits to reduce down your tax bill? Well, the ones that aren't often claimed are as follows. The first one is travel expenses. Now, you probably incur travel expenses driving from your properties to property. You probably incur travel expenses going to view properties. You will incur travel expenses going to see your accountant, going to see your agent, going to see your solicitor, perhaps popping down to pick up something from B&Q, somewhere like that. All those travel expenses can be offset against your rental profits. Now, in the past, it's been more of an effort and a headache to actually capture mileage costs, for example, to offset against rental profits. And by the time you give your income and expenditure information to your accountant, you've forgotten where you've been and what you've done. However, through technology these days, there are apps available that record all your trips that you make in your car, and you can then at some point in time, just with one swipe, either right or left, determine which ones were for your business and which ones are for personal. And then the software then memorizes which trips were business and which were personal, which saves you the effort of identifying them in the future. Apps such as MileIQ is one, TripCatcher is another. There are plenty out there that can do this, and even some in-house car apps such as the Volvo app or the Range Rover app, they have this built-in feature in their own car apps. So now there is no excuse for ensuring that you are capturing all the mileage claims that you possibly can, because for the first 10,000 miles you can claim 45 pence a mile off your tax bill. So if you were doing 10,000 miles a year running your property business, then that's £4,500 of tax relief that you can claim back from HMRC. So don't forget travel expenses. Number two is any equipment that you might use in your business. So everybody uses a mobile phone these days. Computer equipment, laptop, iPad, that sort of thing. I'm sure that you send out emails, or you review tenancy agreements, or you go on Rightmove to search for property. So any equipment that you use for your rental business is an allowable expense. Obviously, if there is some personal element involved, then you need to determine an appropriate ratio. But generally, the HMRC will accept a reasonable proportion of business use to be applied to any equipment or any mobile phone use and that sort of thing. The other one is professional fees. So, accountants' costs and that sort of thing, they can all be offset against your rental profits. And remember that any expense essentially can be worth up to your highest marginal rate. So, for example, if you're a 40% taxpayer or a 45% taxpayer, then any expense that you can claim against your tax bill is essentially saving you 40% of that expense, because you're getting that back as a deduction of your profit. So let me give you an example. If you made rental profits of £10,000 and there was a £1,000 expense that you could claim, you are a 40% taxpayer. That £1,000 expense is worth £400 to you and would reduce your tax bill by £400. Accumulate that with many other expenses in the same amount and it suddenly starts to add up. Last one, which is often not claimed, is use of home as office. Now, presumably, and most people who run their rental businesses would do a lot of it from home. You wouldn't have a separate office, for example, unless you were really big to run your rental business. So you would spend time perhaps on the evenings and weekends managing the business from home, making phone calls, storing records, perhaps having meetings, searching for properties, doing a lot of online work, which therefore gives you an opportunity to claim a percentage of your home running costs, essentially for using your home as an office, against your rental profits. And how is this done in reality? Well, HMRC accept a reasonable proportion of your home running costs. So that could mean your own mortgage interest at home, or your council tax, or your bills, everything added up. And then you would then divide that perhaps by the number of rooms in your house. And if there was a study, an office in your house, for example, that you used for your business, then you could apportion that against the overall cost and take maybe a fifth or a sixth of those costs, and then multiply that by the amount of time you use that particular room for business purposes. I would recommend that you don't claim 100% because you could have an issue with claiming the personal private residence exemption on your home for capital gains tax in the future, but a proportion up to 80-90%, if that's what you use it for, would be perfectly acceptable. So in summary, make sure you are claiming everything you can that is wholly and exclusively for running your rental business, because it can save you up to 45% of the value of the expense against your tax bill. I hope that was useful. For more information, go to www.allaboutpropertytax.com, where you can download a free copy of my ebook. Bye for now.